Everything you must know about silver and gold in July, something is shifting beneath the surface of the global financial system. A silent signal, one that has appeared before every major turning point in modern economic history. Gold has fallen, silver has fallen harder. But what looks like weakness may be the final warning before the next great move. Because history does not repeat by accident, and the pattern forming right now has only appeared a handful of times in the last 100 years. What happens next could determine who builds wealth for the next decade and who is left behind. Stay until the end, because Part 5 reveals the number few are prepared to hear. Welcome back to Precious Metals Intelligence, the channel built for those who study markets not for entertainment, but for preparation. Today's analysis is not a forecast. It is a structural warning, built on decades of historical precedent, cycles, and capital behavior. If this is your first time here, consider joining this community of disciplined, forward-thinking investors. Not with pressure, but with an invitation to think ahead of the crowd. Something unusual is happening in the gold and silver markets this July, and most people watching the headlines are missing it completely. For months, precious metals have been falling. Gold has dropped by roughly 30% from its recent highs. Silver has fallen even harder, losing close to 60% of its value at one point. To the average investor, this looks like disaster. It looks like the end of a dream that many believed in. The idea that gold and silver were entering a new golden age of wealth protection. But analysts who study these markets closely know something the average person does not. They know that not every decline is the same. There is a big difference between a small pullback, a medium-term correction, and a full collapse of a long-term trend. And understanding which one is happening right now could be the difference between panic selling at the worst possible moment or holding steady through what may simply be a painful, necessary pause. Think about it this way. A tree does not grow in a straight line toward the sky. It grows, then it pauses. Sometimes a storm knocks off a few branches. But if the roots are still strong, the tree keeps growing taller in the years that follow. Markets behave in a similar way. They rise for long stretches of time. Then they undergo sharp, frightening corrections. These corrections shake out weak hands. Investors who bought out of excitement rather than understanding, and who now sell out of fear rather than logic. This is exactly the environment forming in the precious metals market today. Prices have fallen fast. Sentiment has turned deeply negative. Financial news channels are filled with warnings that gold's big run may be over. And yet, for those who study long-term market cycles, this type of environment often tells a very different story than the one being reported. Throughout history, major bull markets in gold and silver have never moved in a straight line. They have always included violent, painful corrections along the way, drops so severe that even experienced investors began to doubt themselves. Some of these corrections lasted only a few months, others stretched on for a year or more. But in nearly every case, they eventually gave way to the next major upward move, often catching the majority of investors by surprise because they had already given up and moved their money elsewhere. So the real question is not simply, why are prices falling? The more important question is this: is the current decline in gold and silver a temporary reset within a much larger, multi-year uptrend? Or is it the beginning of something far more serious? A true reversal of the long-term trend that has been building for the past 2 to 3 years? This is the exact question that professional analysts, fund managers, and serious long-term investors are quietly trying to answer right now. And the truth is, nobody can know for certain in the moment. History only becomes obvious in hindsight. At the actual bottom of a market, things almost always feel hopeless. That is precisely what makes bottoms so difficult to recognize while they are happening. But there is a way to approach this puzzle with more clarity than simply guessing. By studying how gold and silver have behaved during previous major corrections, comparing the emotional atmosphere, the economic backdrop, and the behavior of both everyday investors and large institutions, a clearer picture begins to form. Patterns that repeated in the past tend to offer valuable clues about what may be unfolding in the present. This is where the story becomes genuinely important for anyone thinking seriously about protecting or growing their wealth in the years ahead. Because if history is offering a signal right now, the people who understand it early will be positioned very differently than those who simply react to fear, sell at the bottom, and miss what comes next. Every generation believes its crisis is the first of its kind. Every investor watching prices collapse believes in that moment that this time truly is different. But history tells a quieter, more patient story, one that repeats far more often than people expect. To understand what may be happening in gold and silver today, it helps to step back nearly 50 years, to a period few people alive today remember clearly. In the early 1970s, gold entered a powerful new bull market after decades of being tightly controlled by governments. Investors who bought early were rewarded handsomely, but along the way, gold suffered a brutal correction, a decline so severe that many who had believed in the metal simply gave up. Prices fell for months. Confidence collapsed. Newspapers declared that the golden opportunity had passed. And then, Only a few years later, gold did something almost nobody expected. It exploded higher, eventually rising by hundreds of percent, rewarding the small number of investors who had stayed patient through the darkest part of the decline. This pattern was not a one-time accident. It happened again decades later in 2008. That year is remembered mostly for the global financial crisis, the collapse of major banks, the panic in stock markets, the fear that gripped the entire world economy. But few people remember that gold and silver also fell sharply during that same period. Investors who needed cash sold whatever they could, including precious metals, dragging prices down alongside everything else. Yet what followed was remarkable. In the years after 2008, gold climbed to new record highs. Silver followed with an even more dramatic rise. Those who panicked and sold near the bottom missed one of the strongest rallies in the history of precious metals. Those who understood what was happening and held on despite the fear around them were rewarded for their patience. Why does this pattern keep repeating? The answer lies less in charts and more in human psychology. Markets do not bottom when everything looks calm and hopeful. They bottom precisely when hope has run out. At the true low point of any major decline, the mood is almost always the same: exhaustion, doubt, and a widespread belief that the good times are gone for good. This is not a coincidence. It is the mechanism by which markets clear out weak, emotional money before they are ready to rise again. There's a simple way to understand this. Imagine a rubber band being stretched. The further it is pulled in one direction, the more force builds up to snap it back the other way. Fear does something similar to markets. The deeper the pessimism, the fewer sellers remain to sell. Eventually, there is simply no one left to push prices lower, and even small amounts of new buying can cause a sharp reversal. This is precisely why professional investors pay closer attention to sentiment, the mood of the crowd, than to price alone. When nearly everyone believes prices will keep falling, and very few people want to own an asset, that condition has historically marked some of the best long-term buying opportunities in financial history. Not because the fear is wrong in the short term, but because it tends to be wrong about what comes next. None of this means that every decline automatically turns into a rally. Some corrections do lead to longer, deeper bear markets. Not every fallen asset recovers. This is why careful analysis matters far more than blind hope. The goal is not to assume history will repeat perfectly, but to recognize the patterns that have appeared again and again, and to understand what conditions have historically separated a temporary pause from a genuine end to a long-term trend. What made 1974 and 2008 different from ordinary declines was not the price action alone. It was what was happening underneath the surface, in interest rates, in government policy, and in the flow of capital between markets. These forces, largely invisible to the average investor, often explain far more about where prices are heading than emotion or headlines ever could. And that is exactly where the story turns next. Into the hidden mechanism driving today's market, the one very few people are watching closely enough to understand. Behind every major move in gold and silver, there is usually a force that most people never see. It does not appear in the headlines. It rarely gets discussed at the dinner table, yet it quietly shapes the direction of precious metals more than almost anything else. The behavior of interest rates and the decisions of the Federal Reserve. To understand why this matters, it helps to think about gold in a simple way. Gold does not pay interest. It does not produce income the way a bond or a savings account does. So when interest rates rise and safer investments start paying more, some investors naturally drift away from gold toward assets that reward them for waiting. This single relationship explains a large part of why gold has struggled in recent months. In particular, analysts watch something called real interest rates. Interest rates after accounting for inflation. When real interest rates rise, gold tends to face pressure. When they fall, gold tends to find support. This is not a perfect rule, but it has held true across many decades and many different economic environments. There's a second, closely related signal that experienced analysts watch just as carefully. The relationship between short-term and long-term government bond yields, often called the yield curve. When short-term rates rise faster than long-term rates, the curve flattens. And this environment has historically been difficult for gold. But when this pattern begins to reverse, when long-term yields start rising faster than short-term ones, it often signals a meaningful shift is underway, one that has historically opened the door for gold to strengthen again. At the center of all of this sits the Federal Reserve, and the Fed's decisions about interest rates ripple through every corner of the financial system, including precious metals. When the Fed raises rates or signals that rates will stay high, it tends to pull money away from gold and silver. But history shows something important. Gold often begins to recover before the Fed actually starts cutting rates. The recovery tends to start quietly, once investors sense that a shift in policy is coming, even before it officially arrives. This creates a very specific pattern that is repeated across multiple economic cycles. First, short-term rates peak. Then, months later, the Federal Reserve begins signaling that cuts are coming. And by the time those cuts are officially announced, gold has often already started its next major move higher. Investors who wait for official confirmation from the Fed frequently find themselves buying only after much of the early recovery has already happened. But interest rates are only part of the picture. The other major force is something even less visible: the slow, steady rotation of capital between asset classes. Right now, an enormous amount of investment money remains parked in the stock market. Trillions of dollars sit in equities, chasing years of strong returns. Compared to this, the amount of money currently allocated to gold and silver is remarkably small. This imbalance matters more than most people realize. Throughout history, major bull markets in precious metals have often coincided with the ending stages of major bull markets in stocks. As confidence in equities eventually fades, even a small percentage of that capital moving into gold and silver can cause dramatic price increases simply because the precious metals market is so much smaller than the stock market. Picture a narrow river next to a massive lake. If even a small portion of that lake begins draining into the river can quickly overflow its banks. Precious metals function in a similar way. Because so little global capital is currently invested in gold and silver, it would not take an enormous shift in sentiment to send prices sharply higher. It would only take a modest rotation of money away from stocks and toward metals to create outsized effects. This is the quiet mechanism many casual investors overlook. They watch daily price charts and headlines, reacting to short-term noise. But the professionals who study markets closely understand that interest rates, Federal Reserve policy, and capital rotation form the true foundation beneath every major move in gold and silver. And this raises an uncomfortable question for anyone paying close attention. If capital is currently concentrated so heavily in stocks and gold ownership remains historically low, what happens when confidence in the stock market eventually breaks? That question leads directly into the next part of this story, one built not on opinion, but on what professional investors are quietly doing right now, largely out of public view. While most everyday investors watch daily price movements and react to headlines, a different group is paying attention to something far more revealing: sentiment. Professional analysts have learned that the mood of the crowd often says more about the future than the price chart itself. Consider what recent surveys of large financial institutions have shown. Fund managers across the world were asked a simple question: do they believe gold is overvalued? The percentage who said yes recently dropped to one of the lowest levels seen in more than 2 years. In plain terms, professional money managers are, as a group, less worried about gold being expensive than they have been in a very long time. This kind of shift rarely happens by accident. It tends to appear after prices have already fallen sharply, once fear has replaced excitement. At the same time, data tracking major gold investment funds has shown significant outflows, meaning large amounts of money have been pulled out of gold-related investments in recent months. On the surface, this looks negative. It suggests that confidence in gold has weakened. But history offers an important lesson here. These kinds of outflows often reach their most extreme levels close to major turning points, not in the middle of a market's strongest years. The moment when the most money is leaving is often the moment when the least amount of selling pressure remains. Perhaps the most striking piece of evidence comes from a survey of global family offices, the private investment firms that manage wealth for some of the richest families in the world. According to this research, nearly 3 out of every 4 family offices surveyed own no gold at all. Among those that do own some, most hold less than 1% of their total wealth in the metal. For a group of investors known for careful, long-term thinking, this level of exposure to gold is remarkably small. This detail matters enormously. It means that even among the most sophisticated and well-resourced investors in the world, gold currently occupies an almost forgotten place in portfolios. If history repeats and capital eventually begins rotating back toward precious metals, the starting point for that shift is historically low ownership. There is, in a sense, very little existing exposure that would need to be sold. Most of the buying, if it happens, would need to come from money that is not currently in gold at all. This is precisely the kind of setup that has preceded major moves in the past. Extremely low ownership, combined with extreme pessimism in sentiment surveys, has historically marked the early stages of major turning points, rather than the final stages of a market's decline. It does not guarantee an immediate reversal. But it does suggest that the easy, obvious selling has likely already taken place. For business professionals and long-term thinkers, this pattern deserves serious attention rather than casual dismissal. Wealth is rarely built by following the crowd at moments of maximum enthusiasm. It is far more often built by paying close attention when conditions like these appear. When an asset has fallen out of favor, ownership is scarce, and sentiment has reached levels of pessimism that rarely last for long. None of this means the path ahead will be smooth. Corrections can take time to fully resolve, and further volatility is entirely possible in the months ahead. But the underlying picture forming beneath the surface, Low institutional ownership, depressed sentiment, and a historic imbalance between capital sitting in stocks versus capital sitting in gold paints a very different story than the one dominating daily headlines. And this leads to the final and most important part of this analysis. Because once these pieces are placed together, the historical patterns, the hidden mechanisms of interest rates and capital rotation, and the quiet signals from professional investors, a much larger conclusion begins to emerge, one that very few people are prepared to hear, and even fewer are currently positioned for.